today, Sue Day. Sue is a partner in the tax department of leading UK and international tax advisory firm Crowe UK LLP. Welcome, Sue.
Thank you very much, and thank you for inviting me to be on your show.
Well, thank you so much for joining me today. But first of all, I know we're talking about the concept of capital gains tax.
So capital gains tax, or CGT, as we call it, is basically the tax on an increase in an asset. So it doesn't always apply to every asset, but basically it's the difference between what you might sell it for and what you paid for it. So if you're selling a house, for instance, you pay capital gains tax on the difference between what you bought it for and what you sold it for. Capital gains tax doesn't always apply just when you sell something. So it might also apply if you gift something. So if you're gifting something from husband, not husband to wife, but from son to daughter, between siblings or between parents and children.
And what's that new rule that just came into force on the 6th of April 2020?
It's all about changing the date when you report a capital gain and when you pay the tax. So historically, you would put your capital gain on your tax return in the year in which you sold the asset, and then you would pay it on the 31st of January in the year following that tax return. So now the new rules are all centred around having to make a report and make a payment 30 days after the completion of your sale.
And when does the time start running? Is it from the date of completion or from the date of exchange of contracts?
It's from the date of completion. So for in normal circumstances for capital gains tax, the important date is the date of exchange, and that hasn't changed. So the tax point, the date that the disposal took place is actually the date of exchange, but now the reporting date is actually the date of completion, so 30 days after the date of completion. There is one area where people don't need to report, actually, and that's if the date of exchange was before the 5th of April 2020. So if the date of exchange was before then, there's no need to report if you complete afterwards.
And if there's no CGT payable, do you still have to make a report?
No, you don't. So if there's no capital gains tax payable, there's no need to make a report, and there's no need to pay. Well, obviously there's no tax payable. You might still have to put it on a tax return as normal as you would have done, because there might be a different reporting requirement to put it on there, even though it's a loss and there's no tax payable.
What about principal private residence relief? When does it actually apply?
So principal private residence relief applies when you sell your main or only house that you've lived in for at least some or all of the period. So principal private residence relief, the legislation talks about you having to occupy the property to obtain the relief. Now, if you get the relief, so if you've owned the property and it's your only property and you've lived there the whole time, the gain will be exempt, and therefore there's no need to report the gain and there's no tax payable too.
And when does it not apply?
So the rules talk about a house plus half a hectare of land. So if you've got more than half a hectare of land, then part of the gain on that property might not be covered by principal private residence relief because it's outside the permitted area. Now, there are cases where the revenue will look at a garden that's bigger than half a hectare and look at the size of the house and the way the garden is used, and hopefully they would agree with you that extra land is actually part of your house. But if you're in that situation, you need to think carefully about whether or not your gain is going to be covered by principal private residence relief. So half a hectare is an acre. It's about an acre, and it's important to have a look at what that land looks like. Is it fenced off in a different way? Can it be easily accessed from the house and those sorts of things? So it's important to take photos actually of where you live, just in case the revenue actually asks you for what it looked like, and you need to produce evidence of the fact that you were using it as part of your garden.
Yes, very complicated, I see.
Everything's on a case-by-case basis. So yes, and you can't just look at the garden and say if it's more than an acre, this is definitely going to qualify or not. You just have to put your case together and hope you can convince the revenue that to agree with you that that's part of your house.
Can you give us an example? I think that will help to drive the point home.
There's an example that I use where there's a small cottage that has about 10 acres of land with it. And when it's sold together, whether that would qualify for principal private residence. The important thing to bear in mind is obviously 10 acres is way in excess of the 1 acre that's allowed. And a cottage is fairly small. So are the 10 acres actually used in enjoyment for that small cottage? And you could still convince the revenue that those 10 acres might be used enjoyment in the full enjoyment of your house, depending on how it's used. Are there horses on it, for instance, that you use? Is it all in one boundary? And it also helps if the house and the land were bought together and the land wasn't bought as something separate. So as we said before, it is all about individual cases. But just because you don't fit within the rules doesn't necessarily mean you won't get the relief.
Is there any general advice you can give to people who are planning to sell their house in the near future?
I think the most important thing with this new reporting requirement is to be prepared. So as the house goes on the market, have a think about whether or not you are going to qualify for principal private residence relief. There may be an example of where you're not in occupation of that property. So for instance, you've gone to live with somebody else, or you've had to go away to work, for instance. So in those circumstances, you need to gather all your evidence. And as you know, when you're moving house, the last thing you do is look for paperwork. You don't want to be looking for paperwork in boxes that you've packed up already. So have a think about it before you move, before you put the house on the market. Gather together all of the information that you have, so that you've got it ready, so that when you come to have to make the report, if you do, you've got everything there ready to make that report. So to report your gain, you have to have a government gateway ID, which you have to apply for. It usually takes about 12 or so days to get that up and running. Once you've got the gateway up and running, you can then actually give somebody else access to it. So if you've got an accountant, or you've got a friend or somebody else who you would like to file it for you, you can actually give them access. But it's important to get that set up way in advance of the 30-day deadline.
Thank you, Sue, for explaining this difficult topic in such a succinct and easily digestible way. It's been really informative. Details for getting in touch with Sue are coming up shortly.
Subscribe now for more family wealth guest experts.